You're listening to The Intellectual Investor, episode number 66, Investing Q&A, Small Caps versus Large Caps, Increasing Your Circle of Competence, and Should Value Investors Buy Gold, written by Vitaliy Katzenelson and read by Elliot. To listen to more episodes, visit investor.fm. To learn more about Vitaliy's investing firm, IMA, go to imausa.com. Investing Q&A, Small Caps versus Large Caps, Increasing Your Circle of Competence, and Should Value Investors Buy Gold. Nearly every year, I do a Q&A style lecture for students at universities in Denver. To be honest, it is a somewhat selfish endeavor. I really enjoy doing them, and every single time, I learn something new. But since campuses are closed, I decided to take this year's talk online. The upside is that it was easy to record and turn into a useful podcast for you, dear listener. We've split the recordings into two parts to make it more manageable. This is part one. Have a listen.
I'm Brendan. I'm a research analyst here at IMA, and we've got Vitaliy Katzenelson. Vitaliy, I've got a nice list of people on the webinar. I think what we're going to do is we're going to start with some questions. So basically, a big picture, I just want to say welcome, everybody. So we are doing this experiment to, have Vitaliy engage with students in particular, and just kind of the community, the investment community in general during this, challenging time. Vitaliy, is there anything you want to say to kick off the meeting?
Yeah, every year, maybe 4 or 6 times a year, I would do a Q&A talk at DU. And I think there are a lot of DU students now on this webinar, or whatever you want to call this. And I really enjoyed it. And obviously, because of the coronavirus, that opportunity kind of vanished. But I really enjoyed doing it. And we realized we can do this for a much larger community now than just students at Denver University. And the reason I like to do it for students, because I feel like older folks usually want to know, they want me to give them a fish. Whereas students want me to teach them how to fish. And I think I enjoyed that a lot more than just giving fish to other people. So everybody who's on this call, thank you so much for joining us. I'm really glad you're here. And I'm looking forward to answering your questions. So
good. We've got a bunch of people on the call, but I think we have our first question from Mate Gombis. Mate, can you hear us?
Yep.
Oh, you can. Good. Okay, so Mate, do you want to just introduce yourself and sort of just tell us quickly a little bit about yourself, and go ahead and ask your question?
Sure. Thanks very much. So it might be surprising, but I'm actually joining you from Hungary, far from the US.
Welcome.
Thanks. Yeah, so I've been involved with investments for 3 or 4 years now. I'm 20 years old now. I'm hoping to be somewhat of a value investor like Vitaliy you are in the coming years. So yeah, basically that's it. I'm going to finish university next year. So yeah, hope for the best.
good luck.
Thanks. So as I know you, Vitaliy, you are an active value investor. So meaning you're not the buy and forget to sell types. So my question would be whether you sell your entire positions when those surpass your fair value estimates, even if you don't have any other investment ideas to put your capital into. So do you rather hold cash, or are you not concerned about reinvestment risk? Because I find when I make good choices and my initially undervalued stocks become fully valued at least, then I'm hesitant to sell when I have no immediate alternative to invest in a better risk-reward stock. But should I sell anyway?
Okay, so I think it's a great question. And I think my answer to the question has changed over the years. So I think it's probably would deviate from what I would have said in probably one of my books. So let's say you have two companies. One is I'm going to pick on a company just hypothetically. Let's say it's a McKesson. So it would be a company that's very slow growing. So that would be one company on one extreme. On another extreme, you have a company that is growing very, very fast. Okay, so the company that is not growing, that's slow growing company, the range of its fair value is going to be fairly narrow, right? Because what increases value over time is really, the growth, the earnings going higher and higher. So for companies like McKesson, for instance, I would have a narrow band of when I want to sell it. So let's say we would sell it when it gets to 90% of fair value, and maybe sell 1/3 when it gets to fair value, maybe another third when it gets above that, or maybe just do 50-50 and sell 90% at 50% at 90% fair value, and then the rest at the fair value. When you have a company that's growing earnings at a very fast pace, time is actually on your side, and there you want to be selling in a much smaller increments. We owned a company called Twilio, and we've been selling it in a very small, like 15-20% increments over time. Because as company grew its earnings 30-40% a year, or revenues 30-40% a year, the value has been increasing as well. So with companies that are growing at a faster pace, so analogy would be like when you walk a dog, you have a leash that's very tight, that's very smallish. So that's what you want to, that kind of leash for companies that are not growing, or growing, maybe at 3 or 5% a year. Companies that are fast growers, you want to have a much looser leash. So the band of fair value should be much wider. And then I think when you sell it, you probably want to be selling it in smaller increments as well. So I hope I answered your question.
Yes, absolutely. Thanks very much. And I have another one, if I can go ahead.
Sure, go ahead.
And that one is regarding valuing businesses using any sort of discounted cash flow methods or any of its extrapolations. So I would like to ask you if you're not concerned about the righteousness of your input assumptions, because I mean the method that is extremely sensitive to all inputs. So if I, let's say, change the discount rate from 9 to even just 9.5 or even 10% probably, then that's going to lead me to an entirely different price. So how do you deal with that? Or are you that confident about all your assumptions regarding, growth rates, discount rates, terminal value, etc.?
I like the process of discounting cash flows because it puts me in the shoes of an investor, and that's why I like using it. However, the way I look at discounted cash flows, it's incredibly valuable at the extremes. When a company, like if you own a company today, I'm not going to mention that company name, but Brendan knows that company, what I'm talking about. And with that company, it almost doesn't matter which assumptions I put in. If I put a 12% discount rate or 8% discount rate, it doesn't matter what numbers I put in, it's still insanely cheap. So at that point, actually, discounted cash flow gives me the confidence to say, okay, this company is unbelievably cheap. So, and therefore, no matter how much it's hated, gives me the confidence to go and buy it. Okay. At the same time, what I discovered over the years, discounted cash flows is very useful at the extremes. Okay. It's useful and then you look at the company, I don't know, like .com stocks in the 90s, and you put them through discounted cash flow models, you would realize that the impossible things have to happen over the next 20, 30 years for them to be undervalued at the time. So for almost every company we buy, we go through discounted cash flows, but we almost look at it as kind of a shotgun approach, kind of gives us kind of a range of values. And if let's say we put different assumptions, and we get a stock worth between $40 and $60, and the stock today is 10. Well, I don't have to worry about that $60 anymore, right? I just have I know that with my conservative assumptions, the stock is still very, very cheap. So you're right. Discounted cash flow analysis is incredibly sensitive, to the inputs. Therefore, you want to be extremely aware of this. And when you change assumptions and suddenly, company you thought it was undervalued now becomes fully valued, you think, well, maybe that's not cheap enough. So that's, hopefully that was a helpful answer.
Yeah, absolutely. Thanks. Because the reason why I've brought up this question is because, you sometimes can read, for example, research articles, which I put all the inputs together and then the stock is like, I don't know, 7% undervalued. And it always seems ridiculous to me because a tiny change to just one of the assumptions would change that dramatically.
Yeah. Well, thank you very much. I appreciate your questions. Thank you.
Thanks, Mate. Okay, so we're going to go next to Arpit Jain. Arpit, take it away.
Thank you. First of all, I've recently sort of got across Contrarian Edge, and I've read historical articles and the current articles that are being sent out on email. And first of all, they are like really great. And the best part that I like is that they really look unbiased and totally rational, which is the thing that really I find very useful. So I basically have two questions which are kind of interrelated in some sense. So one of them is basically, given that what's going on in terms of the monetary policies across the world, especially the central bank in the US, and also previously the central bank in Europe and Japan, what they've done is that they've basically gone ahead with a lot of quantitative easing and bringing down the interest rates. And likewise, the governments in those countries, they are ballooning with fiscal debt, so to speak. So I just wanted to understand what are the potential or theoretical risks associated with doing these things. And secondly, if this persists for longer, then would it be okay to assume, or would it be wise to assume, that financial markets in the world and the real economy, these two would be having a lot of disconnect from each other, which is kind of what we are seeing right now?
Yeah, it's great questions and difficult questions. A few hours ago, I talked to Ed Chancellor, who wrote a phenomenal book, Capital Returns. By the way, if you're a student of value investing, I highly recommend you read that book. Anyway, and Ed and I were talking about this, and he made a very interesting point. He said, if you think about what's happening today, you basically have in 2008, you had a consumer debt skyrocket. Corporate debt did not go up much, and government debt went up. Today, corporate debt is at the probably close to I'm not sure it's all-time high, but it's a very high, and the government debt is exploding. We're probably going to add $4 or $5 trillion to GDP or more after we're done with this. But what's interesting about this, debt has different impact depending on who has this debt. So when a consumer has this debt, that's actually deflationary, because what happens when you have a lot of debt, that means you have less discretionary money. You have less money to buy, to go to the movies. When corporations have this debt, this is going to be somewhere in between, right? It's probably still going to be deflationary, but maybe less deflationary than if it was, if the consumer was deleveraging. But it would still slows down the economy, and it's still deleveraging. When government has a lot of debt, which is happening today, I think there is a good chance that this is very inflationary. Because what happens when the government has a lot of debt, and God forbid interest rates go up a little bit, then suddenly, government has to take the money that it used to pay, spend on Social Security, and that money, so that debt starts, the interest payments start competing with the Social Security payments or defense spending. Okay, so unlike consumer or corporations, government does not really do a good job cutting expenses. What government do a good job doing is printing money. So what they'll do, they'll still pay Social Security, still pay for Social Security, they'll still pay for defense, and they'll just print money. So that is inflationary. So you have a deflationary force on one side that's coming from the fact that you're probably going to have. So this is a very complex question. So I almost can't really answer it without talking about the coronavirus in greater depth. So I look at coronavirus as kind of, you have AC. You have BC, DC, and AC. You have before coronavirus, during coronavirus, and after coronavirus. You have these three eras, three time periods. And when I think of these three time periods, that the length of during coronavirus will have a tremendous impact on how the after coronavirus environment looks like. In other words, if today we are still in lockdown, right? But let's say we open up the country tomorrow, 100%. So government says you can do whatever you want. So I think what's going to happen tomorrow, the restaurants will still be empty, maybe less empty than they are today, but will still be empty because we still don't have a cure, for coronavirus. So therefore, people will be afraid to go to restaurants, because when you go to restaurants now, what happens is that the cost to that meal is not just what you pay to the restaurant. Also, there's another cost, which is a risk of getting the virus, a risk of getting sick. So my point is, if the economy was open tomorrow, most likely, the economists estimate that the estimates actually for second GDP, for second quarter GDP range that will be down between 9 and 50%. Just think about it. The economy will be down between 9 and 50%. I think Goldman Sachs is probably, I think, a 35% decline of GDP in the second quarter. Just think about it. Normal recession. When we have a normal recession, real economy declines 3%. That's what we freak out about. Like market, when the job number comes out and it's not a good number, the market declines 2 or 3% because market is scared of the 2 or 3% recession. We're talking about economy being down 30%. Okay, so my point is this: the longer we have this, the fear of coronavirus, the longer a good part of the economy basically operates at very low occupancy. So the restaurants are empty, the barbershops will be empty, the movie theaters. The longer that happens, the bigger impact it's going to be on the economy, because right now the economy is still bending. Okay, and if the fear is gone tomorrow, it's going to snap back very quickly. Now, if restaurants are at 20% occupancy for 6 months, they'll start going out of business. And if you run a Mexican restaurant and you go out of business and the virus is cured, and now the Italian restaurant comes back to replace you, now it's a different corporate unit, so it takes longer time to reincorporate again. And so what's going to happen, so the point I'm trying to make, the longer this time during the coronavirus lasts, the bigger consequence is going to be to the time after the coronavirus era. And so obviously government would have a lot more debt, the unemployment would be higher. So I guess the argument I would make is that we probably would have a lot, it's very difficult. I would have thought we would have had inflation over the last 10 years. Obviously we didn't. But I think the chance of inflation go up more and more as the government debt piles up more and more. So I hope I answered your question. What was your first question? That was your second question. What was your first question?
The broad question was that given all this, will it be like a case where the real economy and the financial markets, they sort of run their own ways essentially? Like the economy, there is a great chance that the economy is not going to recover anytime soon. But given that there is unlimited printing of money and so on, that the financial markets just run their course and they keep afloat, and somehow
I think
is there a possibility of that?
Yeah, I think the financial markets and economy can be disconnected for some time, but not forever. So I think it's at some point they'll converge.
Thank you so much for taking my question.
My pleasure.
By the way, I forgot to introduce myself. Sorry about that. So I'm Arpit. I am a computer science and engineering graduate. I right now work in a software firm in India.
Thank you for joining us.
Thank you. My pleasure. Thank you.
Thanks so much, Arpit. One thing that's really great about this whole process is that, we have this really global group of participants. So next, I wanted to...
By the way, we can't see you now. So.
Oh, I know, but that's okay. We only want to look at your pretty face, Vitaliy, so no worries.
I'm not sure that's the case, but that's okay.
Okay, so I've got Graham. So Graham, you wrote in with a question. Would you mind just introducing yourself, and then you can go ahead and ask your question.
Hi, I'm Graham. I've been writing Vitaliy a while. I haven't corresponded with you, Brendan. I'm from Trinidad, and I've been following Vitaliy for a while, reading his articles, and they're always very insightful. So it's a pleasure to be on the call. Thank you for having us.
Joining us.
So my question is a very simple question. I just wanted to know, as much as you could say right now, given the market decline, where are you guys, or in what areas are you guys really finding opportunities? I know the market would have been high towards the start of the year, hitting record highs and so on. And given the downturn, opportunities may have come up depending on where you looked. So is there anywhere that you specifically see opportunities that you can comment on?
Sure. So I'm not going to talk about individual stocks, but I'll tell you this. So from today's perspective, when I look at stocks today, I kind of look at them on two extremes. Okay. And I'll give you two extreme examples. On the one side, you have a pharmaceutical company, and I'm just going to name a name just so you can visualize it better, like Pfizer, or think about any large pharmaceutical company, one side. And if you think about Pfizer, their business has not changed much at all over the last 2 months, right? If you're taking medicine, you continue to take medicine. So it's not discretionary spending. Then on the other side, you have, and I like to use this example because I was just there 2 months ago, and I can just this is the extreme example. Think of a small hotel in Venice, so people usually don't go to Venice for a business trip. So it's completely discretionary spending, right? So that hotel today is completely empty. Okay, so you have you have two extremes, right? You have this non-discretionary spending, Pfizer, and on the other side, you have a hotel in Venice. And so when you look at companies, a lot of them fall somewhere in between. So you look at Chipotle today, and Chipotle, yes, their restaurants are closed to dine in, but their business for takeout is very strong. So they may be somewhere closer to Pfizer, maybe in between. Then you look at movie theaters, and they're right on the side of that hotel in Venice. So the Pfizer's business is very unlikely to be impacted much by the duration of this kind of what I would describe as a DC era, during the coronavirus era. So the hotel in Venice or other businesses that are closer to that extreme, they will be impacted tremendously by how long this environment lasts. Okay, and they will be impacted significantly because the longer that you stay closed, they may stay closed for a month, they're fine, but when it becomes 2 or 3 or 4 months, they start going out of business. So what we try to do at IMA is basically ask ourselves a question: what will not change, even if the virus lasts 6 months or a year, whatever? And so what we found, there are some industries, and there will be exceptions, but there's some industries that probably won't change much. And by the way, the list is longer, but I'm just the ones that we found where we found opportunities. It was healthcare, defense, tobacco. Those would be industries where we probably have the biggest exposure. So that's how we approached it, because we're hoping that this is over in a few months. Gilead has a cure, or there's a vaccine, or whatever, or the sun comes out and the virus just dissipates. Who knows, right? We hope it doesn't last very long. However, hope is not a strategy. So therefore, when position our portfolio, we want to err on the side that it's going to last much longer, and therefore we want to stay on the side of not a hotel in Venice, but on the Pfizer's side, on the, basically sticking with companies whose business, telecom would be another one actually. They sticking with businesses whose cash flows will not be impacted by the virus because their products are non-discretionary, etc. So that's, Graham, hopefully I answered the question.
Yeah, perfect answer. Thanks. And thanks for taking my question.
My pleasure. And by the way, somebody asked me if this is wine. No, this is coffee. So.
Okay, let me see here. So next, I'd like to ask Biamba to please ask their question.
All right. Thank you for hosting this, Vitaliy and Brendan. I had the opportunity to meet Vitaliy before, and ever since I've been following him, reading his blogs, and the podcast is amazing, by the way. So love the podcast.
Well, you got to thank Brendan and Elliot for that because they work on this together. So
everybody in the team, appreciate it. I consider myself a value investor, but I always like to be flexible. So I guess active value investing is definitely my approach. And so my question is regarding the current environment. Would covered call strategy be a good choice? Because I've been using, Delta Airline is one of my options. So I know Delta position from my research, they're one of the highest quality airline stocks out there. So I believe once we come out of this, their stocks will definitely rebound. But like you were saying previously, it may take some time to reach there. So I've been writing call on Delta and hoping to generate some premiums on it. And I wanted to hear your opinion on using covered call option strategy while waiting for the value stocks to rebound.
I'm very conflicted. And I think this is a strategy that has to fit your personality a little bit. So to some degree, it's better to do covered calls today than it was 2 months ago, right? Because the volatility is more expensive. So the premiums are more higher, right? So
exactly.
So from that perspective, it makes sense. The problem is it's almost like, this is, like when you do dividend investing, the danger of, and I spent a lot of time talking about dividend investing, but there is a similarity here as well. So when people just focus on investing in dividends become kind of this shiny object, which almost derail your research. Not necessarily derail, but they basically, you start looking not at businesses, but you start looking for dividends and then just justifying buying a stock because it has a high dividend. So it becomes kind of a shiny object, which could actually have a significant impact on the construction of your portfolio, not in a good way. I fear the risk of this strategy, at least you want to be aware of that risk, is that you start looking for companies where the premium is high enough. And so you start buying companies not necessarily, like, let's say normally you would never have bought Delta, hypothetically. Mm-hmm. But now you're buying Delta because, well, you can make a lot of money on the dividends. I mean, not on dividends, on writing calls. And the risk you run in this strategy is that you end up playing with stock you would not have played otherwise. And so you make money on calls, and then you just lose all the money on just because you bought lower quality company than you would otherwise. So I'm not saying you shouldn't be doing this, just trying to point out a risk. And then another risk is basically the market rebounds and suddenly you get those stocks called away from you, right? And then your upside is capped. So those are the risks that you're taking when you're doing the strategy. It's maybe appropriate sometimes. That's not something we do, but I know the people that do this, and all I'm doing is just pointing out the risks. That's it. But I'm not saying this is not something you should be doing or should not be doing.
Yeah. I usually don't mess with options because I'm not very fluent with them. But I always remember Warren Buffett's quote saying, "Be greedy when everyone's fearful." So this is me just being greedy during this time. So given that, what's your opinion on the oil? And do you think we will see a rebound once the market opens? And do you think if that rebound will be significant as the drop was?
So oil, I think the longer the oil prices stay at this level, the more likely that we're going to see much higher oil prices, because what it does right now, it's basically destroying supply. So you're going to have a lot of companies going out of business. And it's if you think about oil, it's very simple, right? In the pre-coronavirus era, you consumed about 100 million barrels a day, and you produce about 100 million barrels a day. Today, if after coronavirus, our consumption comes back, let's say to 90, I don't know, whatever that number is, 80 or 90 million or 95 million barrels a day, and suddenly the production is behind us, is less, you're going to have much higher oil prices. The one risk there is, I think, the China, when I look at China in the past was kind of the incremental consumer of oil, and they drove, as the economy grew, the consumption went up. And if that economy kind of goes through, because this is like, I'm going to open up a new can of worms, but China did not go, like, we had problems going into this, crisis. China had its own even bigger set of problems going into this crisis. When I was talking to Ed Chancellor, he reminded me about this article I wrote about China 10 years ago, when I basically compared Chinese economy to the bus from the movie Speed. I don't know if you guys remember this. This is the movie.
Yeah.
Keanu Reeves, yeah, exactly. Dennis Hopper was the bad guy. He wired the bus to blow up if it goes below 45 miles an hour. So, like, Chinese economy, I felt it's very similar to that, in a sense, to that bus, because it had so much debt and it needed to have growth at any cost. And if the growth slows down, suddenly, they're afraid they would have a, social unrest, etc., on their hands. So to me, China is a wild card. If it wasn't for China, then I would say, yes, most likely oil prices would go through the roof. What happens to China is going to be kind of the wild card that may prove me wrong. So I don't know. But that's how I'm thinking about it, at least.
What should I keep an eye out? Like, what kind of news should I keep an eye out from China? Like, what do you think will?
I think you want to look at not the official numbers like, wow, GDP grew 6%, because those numbers are highly manipulated. Mm-hmm. You probably, during the financial crisis, I looked electricity consumption, production or consumption numbers. And then there were some other numbers that are kind of more difficult to manipulate. Maybe look at imports and exports, this kind of stuff. I forget, there's some other numbers you can look at China. There are secondary numbers that are a lot more difficult to manipulate.
All right, that's great. Thanks, Bianca. Those were really terrific questions. Okay, so next.
Can I ask a question? Do we have any DU students on the call?
DU students? Actually, I wanted to mention this. You should be able to raise your hand. So I just want to encourage everybody, especially if you're a DU student or if you're a student in general, go ahead and raise your hand and we'll take a question from you. We've got a question here. So we've got Andrea Lisi. So Andrea, I'm going to make you a panelist. Andrea, you raised your hand. Thank you for raising your hand.
Hello, can you hear me?
Yes.
I can hear you.
Hi, how's it going?
Great.
I'm Andrea, calling from Maryland, but I'm originally Italian. And I'm the director of commodity acquisition for a multinational here in the US. But my background, I grew up as a quant in the second biggest insurance in Italy. And I have a couple of questions for you. The first question is more of a comment relating to the first colleague that was calling from Hungary. And he was asking you about, the sensitivity of discount cash flow model to valuing stocks, right? Mm-hmm. In my opinion, also, because of the sensitivity, for instance, on the terminal value, right, in the formula, I think also to do sensitivity analysis on the input could also help giving a kind of range of outcomes that maybe can guide the investor, right, to a more educated guess about the potential outcomes, right? And I would like to ask you if you agree on that.
All right, I'm going to approach this. I'm going to try to answer this from a very different perspective.
Yeah.
I think Keynes, who said it, and Buffett repeated it, I would rather be vaguely right than precisely wrong.
Yeah.
So the discounted cash flow analysis is a vaguely right model, okay? Mm-hmm. And that's how you want to approach it, okay? So like my favorite company to analyze is where I can do my analysis with a crayon, okay? Because I can just take a crayon from my 6-year-old daughter, take out a napkin, and figure out what the company is worth, like in a very simple terms, right? Because then it means it's very, very cheap. I don't have to be brilliant, right? I'll give you an example. Like I wrote a few articles, like I wrote a lot of articles about Apple, but in the 2012, 2013, I wrote a lot of articles about Apple when we were buying Apple stock. And at the time, if you look at my discounted cash flow model, if you look at my models, they were crayon models, right? Because the stock was so cheap that my assumptions did not have to be like, I didn't have to be wrong in terminal, I didn't have to have a precise terminal value. I could be very vague and I would still spit out that the company is cheap. As stock appreciated, my IQ had to go up with, with the stock price, right? Because now I had to think about it, okay, what's the replacement cycle for iPhone? Is it 2.5 years or every 3 years, right? So the point is this, that model is a very vague, so you should approach it as a very vague model. And whenever it spits out a very precise, but the problem is math, right? It gives you a number that if you want, you can carry it out to 10 decimal points, right? Yep. But it still gives you one number. So you should really be very careful when you use this discounted cash flow model. And really, like whenever you start tweaking with the model, and so that part of the answer would be the same. And you realize, well, if I just tweak this a little bit, now the company becomes overvalued. Or if I tweak, then it's very much possible that you're probably looking at the company that's kind of, maybe the range of fair value is, is here, and maybe it's right here, something like this. That's point number one. Point number two, the way I like to use discounted cash flow model is basically trying to put in extreme assumptions and see how these extreme assumptions compare to the stock price today. Mm-hmm. Okay. Yeah. And I think it's whenever stock is down a lot, right? a lot of times it's very difficult psychologically to buy into the stock because you are on the lonely side of this trade, right? Because everybody, the world hates it, and you have to have this, and you have to be arrogant and say the world is wrong and I'm right. Okay, your arrogance could come from different sources. Your arrogance could come from a source saying, "Well, I'm a smart guy. Girls seem to like me. My parents like me, and therefore I'm going to buy the stock because I'm going to be brave. I'm going to buy the stock." So that's one type of arrogance. But there is another, what I would call thoughtful arrogance, is when you do research, when you play with different assumptions, when you and you try to kill the business and you can't. I know that's to me, that's a thoughtful arrogance based on research. And discounted cash flow model becomes very beneficial in that case, right? Because you're basically coming to conclusion that, yes, the market is concerned about this, and this. And when I put this into the model, I still think the value is much higher than worst case scenarios. Yeah. That's how I would approach, any kind of modeling you do. So in fact, that's most of the modeling we do at IMA. That's what we spend our time on. It's not like a lot of times, especially when it comes to discounted cash flow model, it's not what the company is worth. It's what it's not worth. Like, if we do this, and this, if these things happen, would we lose money or not? So that's how, this is a very long answer to a very good question, by the way. So.
Thank you. And then my second one would be relating to portfolio analysis. Yes. If I think about value investing, I mean, I've read some books about Benjamin Graham, right? Which is one of the most famous value investor of all times, right? And also in his book, he was thinking about how to share between equity and bonds. Now, after 80 years, it seems that the world is upside down with all this quantitative easing, zero interest rate. Do you think that at this point of time, maybe having bonds in a portfolio, even government bonds, is as risky as having stocks? And because usually the bond side of a portfolio should be kind of an edge. I see now also bonds that are very, very expensive. So would certain areas of equity investing, like value investing, be the new bond part of a portfolio?
Okay, so let's try it. Let's try, when you think about bonds, let's think about 3 risks that you take when you buy bonds. Number 1 is the duration risk, right? So if interest rates go up and the stock price declines, so that's one risk. Number 2 is a default risk, right? So when it's a company goes out of business, and so you don't get your money back. And third risk is basically inflation, right? So the payment you receive is less than the inflation. That's okay. So the corporate bonds today, basically, bonds today in general provide very low return overall. I'm talking about investment grade bonds. So there's some areas in the bond market that were distressed a few weeks ago. I'm not sure they're distressed anymore, right? But so when you are buying bonds that you would intend 15%, whenever we had a dislocation, right? But I would argue that type of investing is a lot more closer to equity investing than just kind of what you describe in the kind of conservative bond investing, right? So the corporate bonds in general today not providing much yield, and the interest rates are very low today. And could they go lower? Why not? Could they go negative? Why not? Okay, but would you want to take a risk that if the interest rates go up and suddenly you would lose a lot of money, right? Because today you basically when you buy bond, like long-term bonds today, you're basically getting return-free risk, right? Yeah. So the bond market in general does not excite me. However, like today, to me, you have 2 assets really. Kind of, you have cash, which what used to be kind of short-term bonds, right? Or short-term bonds, government bonds. So there is no default risk there. If you own short-term government bonds, like T-bills, there is no default risk. and there is no interest rate risk. In other words, there is no risk that interest rates go up and and the value of your bonds decline. But you still take an inflation risk, right? That the inflation will eat away the buying power of your of that asset. So I would argue if you could find a very high quality company that has pricing power, and that should be pricing power should be part of the definition of high quality, that has a good balance sheet, again, high quality company, and you buying it very cheap, you have a significant margin of safety, and this is the key point. Actually, I should have started with that. And you have a long-term time horizon, right? So you're investing for the next 10 years, right? So you don't need this money for the next 10 years. Then I would rather own that type of company than almost any bond out there. But however, if I can't find a portfolio full of the stocks, then I would rather own the short-term treasury, waiting for opportunity to buy the stocks, Okay. But in other words, I would approach the kind of short-term treasuries as a placeholder waiting for high-quality, undeveloped companies.
Thank you.
Great.
My pleasure.
Thanks so much, Andrea.
Thank you.
Just want to again just highlight how grateful and honored I am that we have such a great, diverse, global group of people here that we get to interact with. It's really an honor.
Absolutely.
Thank you for listening. This and other investment articles by Vitaliy Katsenelson are based on value investing principles that were first brought down from the mountain by Benjamin Graham and later were popularized by Warren Buffett. To learn more about these principles, visit investor.fm and listen to the first episode of this podcast titled The 6 Commandments of Value Investing. To learn more about how Vitaliy's investment firm uses these principles to create low-risk, long-term oriented portfolios, visit imausa.com. Enjoy life and prosper.